Good afternoon, everybody. Welcome to your Trading Merlin show. It is your Friday Trading Week wrap-up edition. A mild costume today. Normally, I'm much more elaborate, but the costume I used for Halloween, suffice it to say, it did not survive. It didn't make it through the vacation. So we went as an 80s rapper today. I'm just a bit disheveled. I've been wearing this thing all day, and it actually broke, but whatever. Got to have something on set. You know, got to have my bling and represent over here. Hope you all had a great trading week. And by the way, cheers to Wendy, Tyler, Abby, Adam. They bought me this nice bottle of Colonel Taylor small batch, which of course you can see did not last through the Halloween party too much. But cheers to all of you. Happy Friday. We got a lot to talk about today, so I'm going to do my best to run through as much of the market recap for the week, show you the results of a couple of trades, and then I'm probably going to wrap up early because I have hundreds of trick-or-treaters that I need to prepare for and figure out how to scare the daylights out of. And I look at it this way. If I can scare and prevent a trick-or-treater from making it to my front door, then that means I give away less candy. So over time, this is a business opportunity for me. So cheers, everybody. Happy Halloween. Ooh. Are there numbers after everyone's name? Yeah, something happened with YouTube. It used to have names like, it's changed the names. I'm not sure exactly why. It changed the way that names look. Anyway, I'm not a pimp. I'm a 1980s rapper, yo. And I have to be careful here, just so you guys understand how sensitive people are. I did power trading radio for 10 years. And I did a show where I was talking about 50 Cent, the rapper. So 50 Cent one time on Twitter posted out that you got to buy this specific stock that he was given a whole bunch of shares to, which is called fomenting. You create an impression about something, which technically is illegal. You're not allowed to do that. So I was making fun of 50 Cent. And I went, yo, you got to buy this stock, you know? I was threatened with a lawsuit from a lawyer who basically told me to knock it off or I will get sued. I'm like, really? You're that sensitive that I said, yo? They say it on Yo MTV Raps every single day. Anyway. Let's move on from this silly stuff. Yeah, Big Bri, kind of does look like LL Cool J. I've got the wrong color here, but I could do a little LL Cool J raps, but I'd prefer to do like Run DMC raps. That's way better. We're not rapping today. Let's get into the show. Trading Week wrap up. A little bit of a haunted effect here for our 1,222nd show. I'm going to start off talking, I guess, about the Magnificent Seven. That really was the story of the week. For me, it wasn't so much rates. Rates were interesting, but fairly predictable, right? I think everyone kind of assumed it was going to be 25 basis point cut, and that here's discussion about maybe in December. And that's exactly what happened. So nothing too big there. I think what was more compelling from a longer term perspective was the Magnificent Seven, right? The Magnificent Seven to me was kind of the big deal for the week. So let's do a couple different things here. I got all kinds of stuff I want to do, but I'm going to start with the Magnificent Seven, and we'll work our way up from there. Of course, this significantly impacted. You need to hike at the pant leg? Maybe I do, Tofi. Maybe my pant leg is already hiked up. Ollie, yes, I could probably do the Beastie Boys better than, well, Run DMC. I've actually wanted to do It's Tricky as one of my karaoke songs when I go to the bar, but that'll have to wait and see. So the Magnificent Seven is that piece that we all know have been the fulcrum for our entire equity markets. Whether you're talking the Dow, S&P, NASDAQ, it doesn't matter. These are the stocks that are moving up there. I think right now 37% of the S&P 500 is the Magnificent Seven. That's ridiculous, and it's just too much power. That can't happen for too long. I mean, it's just a dangerous situation to be in. So let's start with a variety of different earnings announcements today. I'm going to run through them and kind of give you a quick rundown of some of the numbers I've gleaned from the financial statements so we can see what that looked like. First one on the docket was Alphabet. All right, Alphabet, great earnings. I mean, they were one of the few that actually beat earnings. Two companies beat earnings. That was Google, that was Amazon. Two were in line, that was Microsoft and Apple. And one missed, which was Meta. Dun, 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 dun. All right, so we'll start off with Alphabet, right? Alphabet reported on Wednesday, so no big after market close, so no big deal there. It's already kind of in the past and factored in. But Alphabet was supposed to come out at $2.26. They came out at $2.87. So clearly a great earnings per share beat. The numbers were pretty good. And what I want you to keep an eye on is revenue gain percentage. So for example, they said they had a Q3 revenue of about $102.3 billion. That's 16% year over year growth. Pretty darn good. Next on that list was their earnings per share. Their earnings per share increased 35%, which I thought was pretty impressive. When you start getting into the high double digits like that, or at least the mid double digits, 35% year-over-year growth is phenomenal. Excellent job by Alphabet, and part of the reason that their stock is just going nuts. Where did it come from? Cloud revenue. So their cloud hit big time. They were up 34% year-over-year on cloud revenues, up to $15.2 billion. Advertising and search also increased, but not as much. They were up 14.5% for search, and YouTube revenue was 15%. Now, what I'm interested in the next earnings number, we get to Q4, I'm going to hopefully go back and remember to look this up, but I want to see how search did, right? YouTube, I don't have a problem with. YouTube's going to be fine. But search, I think AI is going to start to eat away at this a bit. And I don't think you're going to get 14.5% year-over-year growth. My guess is you're probably going to see dropping year-over-year gains, nowhere near 14.5%. We shall see how that all pans out. And lastly, they raised their full-year CapEx expenditure to 91 to 93 billion. Now, the Magnificent Seven collectively has said they're going to spend about $200 billion in AI this year. They're ramping it up more for 2026, which should be a good thing for any of you who are holders of the Magnificent Seven stocks, particularly NVIDIA, because a lot of this CapEx expenditure for AI is going to filter right into NVIDIA and maybe even some of these other ones like AMD and Broadcom. So, Miles, I didn't realize you guys can see my whole control setup over here. My favorite crypto pump and dumper? You talking about me? Don, I don't know, you're out of your mind. I ain't no pump and dumper of crypto. I'm a holder, man. I don't know what you're talking about. You off your rocker, son. All right, let's go check out some of these charts. So we'll start off things with the Google, the old alphabetter. Bam. After that big earnings announcement, you had that huge jump up there and then close that gap. This was that blow-off earnings announcement we talked about when it happened. He said, wouldn't be surprised to see it come and fill that gap. And we got pretty darn close to it filling this gap today, although you got to go all the way down to 275.10 to get there. And our low for today was only 277. We were $2 away from filling that gap completely. I personally would call that a filled gap just because we're so darn close. Now, at this point, you look at this and you go, we've got a perfect uptrend. I feel like it's got a little long in the tooth, so I would expect there to be a little bit of a retracement next week, especially because you had such high volume on the earnings. You had the giant gap and sell-off all day long. To me, most likely going to head lower here, even though you have these just fantastic numbers reported for Alphabet. Second one for the week was Meta. So Meta was kind of in the doghouse because they missed on earnings. Now, you'll see here in a second, I'll explain the miss, but the first piece here was their revenue was $51.24 billion. That's a year-over-year increase of 26. So not as good as Google, but still 26% year-over-year is phenomenal. Their diluted earnings per share was only $1.05. This is where they got their teeth kicked in. Now, before everyone freaks out and it's like, oh, well, Meta's done and they're losing money. This is a one-time tax write-off. It was like, a huge charge of $15.93 billion was a non-cash tax charge. This is what crushed them, okay? If we take that out, right, they were, last year they were $6.03 per share, and now they only reported $1.05. I think a lot of people are like, oh my God, this is terrible, Meta's done. Look, it's a one-time charge. They'll get back on track. If you exclude that charge, their earnings per share would have been $7.25, which would be a much bigger beat than what they came out at. So unfortunately, they get these write-downs every now and again. Was not good news for Meta. And overall, they said they as well are going to increase their expense outlook to 116, 118 billion, and CapEx to 70 to 72 billion. So these two firms so far, with Google and Meta, have both said, raising our outlook, man, jumping it higher. We're pushing higher and higher and higher. Meta better chill. It's time for a green candle. Well, you look at that Meta chart. I would agree with you. I think that pain point, that freak out moment for Meta should come to an end here soon, but I didn't find anything that I was really that excited about from a technical perspective. You could look at this low point here, which was right around 622, where we gapped up, tailed into it, and then came back into it on May 23rd. For me, I think it's probably more likely that you'll see it close this gap, which, the gap origin, I can't tell that candle's name, green or red. So 549 would be closing that gap. And again, below that, you've got a bunch of little gaps as well. So not the best looking chart here. I was looking at selling some puts on it this morning, but I decided to just stay away from it just for now. I am in that camp of feeling that things are getting a little too toppy, especially when we talked yesterday about how some of these projects are pulling so far away from their moving averages to the upside. Not good, all right? Definitely not good. Okay, next on the list, Microsoft. So Microsoft was in the inline category. Nothing super exciting here with Microsoft, unfortunately. I know a lot of people wanted to keep on rallying because it's number 2 on the market cap list for now anyway. What do we get? Well, Microsoft reported $77.67 billion in Q3 of revenue. That was up 18%. So we've cascaded down from 35 to 20-something, and now we're at 18.4. Not that good. Where do they get their business? Cloud. You'll see this as a recurring theme for most companies, Amazon as well, but the cloud business was doing very well for them. They grew their business roughly 39% year over year. Great numbers there for Microsoft. Next piece here was operating income and margin growth, still positive, but cost pressure. What do we talked about this 6 or 8 months ago, where I was concerned that we're going to get to this point where companies are spending so much money on AI and hopefully jumping on that train as it takes off, arguably it's already taken off, that the shareholders are going to demand results for that. Microsoft is one of those victims where they're spending tons of money on AI, but they've commented that, that's a lot of expenditure going out. I didn't see the numbers on what they said they were going to do for CapEx next year. That forecast was not, at least I didn't see that forecast going forward, but I would assume it's to keep up with the Joneses world. And if, Google's going to put out $90 billion, well, they'll probably put out a good 60, 70, 80, 90 billion as well, just to keep up with the Joneses. Now, Microsoft, from a technical perspective, I would argue it's one of the worst of the Magnificent Seven. You've got this just really stretched out double top. It has really not done much for the past few months other than kind of traverse sideways. Doesn't look very good. Now, I do have a moving average on here. I think this is the 50. I normally don't use moving averages, but you can even see the moving average is pretty much traversing sideways and doing nothing. So far, Microsoft looking the worst out of all of these, and we'll jump more into each one here in just a little bit. Big Eb says, Microsoft and Meta sucked this month. Yeah. That they did, but they can't all be dynamite, amazing months. You're going to have some crappy ones along the way. All right, next victim. Next victim was in line, and that was Apple. So Apple came out and reported earnings of $101.8 billion in revenue. Now, here's where I think it starts to get bad. You look at this, you have 7% year-over-year growth. Now, these other 3 that we've looked at are all in the double digits, right? You've got Google at 35% revenue growth, and Meta was looking pretty good. Apple, which arguably was the king a couple years back, it's been the piece that's been pulling this market up, and all of a sudden we've had this shift of leadership into NVIDIA being one of the big leaders, and obviously Google carrying right now. 7% year-over-year growth is not really anything to write home about, especially in a market that's been this robust, right? We've had this market just screaming to the upside. Apple, on numbers like this, to me, would be a short opportunity. I know it looks great. I know we're trending really strong, but out of the Magnificent Seven so far that have reported earnings, this one looks like garbage. From a technical perspective. Thank you, Rita. I was going for an old 80s rapper. The reason I have this costume is, well, first off, Trading Academy had a conference years ago, and it was an 80s theme, so I went as an 80s rapper. But also, one of my friends came in from Italy, and we went to a party, and he saw my costume, he goes, I'm going to be a rapper as well. So I was in red or burgundy, and he was in white, so we look like Dumb and Dumber out there, man. We look like Dumb and Dumber at this party. But you know what? If you're going to dress up, go all in. I've even got the red Adidas shoes and all that stuff. Yeah, I got it. You get it. A sniper. Just a rapper, Les. Just a rapper. And then 80s rapper, just trying to keep that going. All right, so even though Apple's chart looks phenomenal, right? This trend is so beautiful from April, and you've busted into all-time highs. I gotta say, I don't like it. I do not like the fact that you got 7% year-over-year growth for your revenue, and your earnings per share has only increased 7%. Not good for me. With that costume, you should do a quick YouTube short talking about Hawk Tua coin. Yeah, right. Hawk Tua coin. That's another big scam. Okay, this is your big winner on the week, Amazon. And the numbers aren't as good as some of the other ones, but Amazon just soared. They had revenue in Q3 of $177.8 billion, up 12% year over year. Their earnings per share only increased 10%. That was $1.58, but they beat. Don says don't short Apple. That's why people trade. You can do the difference of what I can't trade Apple, by the way, so everyone knows I can't short Apple. I'm not allowed to touch it. So I hate Apple. I don't like their chart. Well, I love the chart. I love the chart from a long perspective, but I also don't like 7% year-over-year growth for one of the biggest companies out there. But cheers. Go ahead and keep on. All right. Now, Amazon had huge jumps in Amazon Web Services, right? Amazon Web Services was booming for them. That's a big part of their revenue came there. And then they also had increasing e-commerce margins, and that was part of the big catalyst there to the upside there for Amazon. Of course, when we look at their chart, this week was great if you're an Amazon shareholder. Massive, massive gap up today, but big red candle, right? I think today was kind of that into the weekend kind of, well, what do we do here? They were up 9% on the day, over 9.5% intraday. And from a technical perspective, the chart doesn't look that great, right? Apple looks better. Apple, from a technical perspective, looks far better than Amazon right now, but Amazon just had this blowout earnings, and money just poured into it today. Up again, over 9%, and is up another 0.19 as the market closed today. That was to me, the big victor this week. Did I go through all of them already? Amazon, Apple, Microsoft, Meta, and Alphabet. So I did all 5 that reported earnings this week. What's unfortunate is next week, what do we get? Next week, you got Palantir on Monday and a slew of smaller companies, but nothing in the big tech space. And again, the tech space has been the one that just ripped to the upside and caused all the big gains for our equity markets. Now, all of a sudden, the markets are going to be looking for something else. Next week, you should have some unemployment data, but remember the government shutdown. We may not get that unemployment numbers on Friday, or there's actually numbers on Tuesday, Wednesday, Thursday, and Friday. We may not get some of those numbers, which could lead the market to question where we are actually headed. The other piece you have next week is going to be, off the top of my head, I think you have the British pound. The UK will be coming out with their rate announcement, and so will the Reserve Bank of Australia, but those aren't really driving forces for the US. So Big Eb says, juggle the chainsaws and short Apple with Amazon. No. I can't short Amazon because I love Amazon, and I would love to short Apple, but it's in my trading plan that I cannot short Apple, so I will never short Apple again. I'll never trade Apple ever again. All right. Let's see. And Don, I'm curious about your pump and dump crypto comment, bud. What are you talking about there, man? Who's pumping and dumping crypto? CRISPR trade for 5%. Whoop, whoop. Gotta love 5% in a day. Gotta love 5% in a day. Let's see. What did I have on all those? I only had a couple trades this week. I've been really light on the account that I show you here. What do we have? Let me run through the positions I had. So here is the positions I had. You guys know I sold puts on MP at the $62 strike. That was great premium. You know, you're talking almost 4% for just this week. I sold those on Monday. So basically made 4% for the week on MP, which was great, and it expired above my strike, so that's fine. I sold the MicroStrategy 245 puts, collected 395, so that was over 1.5% for the week. Fine there, those expired worthless. And I told you I took a real gamble just because I liked FI. They have been murdered. I mean, their price chart looks so bad. So bad. You see here they were just clobbered on their earnings announcement, and basically, again, I talked about this yesterday, but they shifting over from the New York Stock Exchange to the NASDAQ. They have a whole board shakeup, and just a lot of questions about where they're going. But their numbers, their financial numbers, still look pretty good in my opinion. They're still, $2 a share was reported, so I think that still looks good. So I sold the $62 strikes expiring next Friday for $1.25, which is about 2% for the week. So those are the only ones I really have open right now. We shall see how it transforms next week, or what I feel might be a good opportunity for next week. Now, what do we got? Is it normal that all the sectors are underperforming the S&P except tech and communications? No, it's not. When you have kind of a disconnect, in my opinion, Luis, that's what we have here, is you have tech throttling everything higher. The concern that you have is when you look at those tech names, they're the pieces that can make or break the market, right? So if it's been dragging the market higher and higher and higher, even though you have many sectors that are underperforming, and we can look over here. Let's go to our sector ETFs. Most of them are up today, so it wasn't like anything really bad. The one that was interesting for me today was consumer discretionary spiked. You're up 2.64% on consumer discretionary, but you had utilities are down, building materials are down, healthcare was down. There's not always going to be that perfect correlation between markets and different sectors, but usually you would like to see more sectors than not follow to the upside. Now, I brought this up here. Let's go to, I'll just bring this up and type in market sector weightings. Bring up the weightings up here for the S&P 500 so you guys can see that bad boy. And ad blocker, get out of here. All right, let's go to S&P companies. When you look at that top list here, as soon as it populates, which it hopefully will populate soon. I don't know why we're taking forever and not loading. There we go. There's your tech. NVIDIA, Apple, Microsoft, Amazon, Alphabet. You could even throw Broadcom in there, all the way down to Meta and Tesla, which I would argue is a tech. I know we get some people that disagree. They say it's a car company, but I am in the camp of I think that Tesla is a tech firm. The top 9 companies in the S&P 500 are all in that tech space. So as these guys reported earnings this week and last week and continue to drive, of course, NVIDIA has not reported earnings. That's going to be in another couple weeks. But all in all, they're all performing extremely well. Obviously, NVIDIA having a breach of $5 trillion, pretty amazing. But there's that adage that I love to use in trading, which is you live by the sword, you die by the sword, which I love telling people that trade penny stocks, because every now and again they will brag about how they made a bunch of money on some tiny little penny stock, but they spend the next 3 years trading a bunch of garbage that just loses them all their profits. So, we're all loving it because these Magnificent Seven stocks have been just grinding this market higher and higher and higher. But at some point, I don't know when that'll be, this may all start to slow down, especially companies like NVIDIA. All right. My concern, as I mentioned before with NVIDIA, is NVIDIA has been facilitating most of the deals that deal with NVIDIA. And that just seems like a drug dealer getting high off its own supply, and at some point that may come home to roost. Hindenburg, yeah, whatever. Yeah, Hindenburg, no big deal. Louis says, so would it be safe to say we are in a bear market, but since the S&P is so heavy in tech, that's the reason the charts are not... I wouldn't say that we're in a bear market. I certainly would not say that. Even if you look at the different market segments, so let's go to something like building materials. Now, obviously, building materials is slowing down, but what's your definition of a bear market, right? The bear market is 20% off the all-time high. That's when you get that bear market. So let's go back here to the high we saw on, let's say, building materials from July. And you go to where we're at right now. You're down 7%. You could argue from this all-time high way back here, but I wouldn't argue man, who drew all these dang lines? It's getting crazy. Let's remove some of this stuff. Let's remove all drawings. And I'll get rid of that simple moving average. This certainly isn't performing that great, but it is trending to the upside, right? Things still look okay. You go to something like technology, we know that's just going to be going parabolic, and this chart is literally off the charts. Financials, I'd argue, still a trend, right? You got a nice bullish market here. Financials are looking strong, even though some people are worried about the raising rates, etc. Well, look, financials are still performing rather well. Industrials, still looking great. No bear market here. Real estate, no bear market. It certainly has slowed down, but it's not a bear market. I mean, right now, IYR was just traversing sideways for the past 2.5, 3 months. Boring. What else do I have on here from a sec? Energy. Okay, it's certainly well off its highs from way back in 2024, but it's been trending up. It's kind of chopping sideways. So I certainly don't think that I would call this a bear market. And here is, consumer discretionary. We've been at all-time highs. We're sitting right near the top. So certainly not a bear market in any stretch of the imagination. But are some of those segments underperforming tech? Of course, right? You're always going to have that. Rob says, great bullish October. Yeah, and the good news for the month of October is we didn't get that big crash that people are freaking out about, right? There's always this belief that the biggest crashes happen in October. And historically, that may be true, but we don't have to approach every October believing that this is going to be the end-all, be-all, and we're all going to just lose our portfolios because of an October crash. So cheers to the month of October, which is the best month, by the way. I'm a big fan of the month of October, for obvious reason. Steve says, this is the best October I can remember. I'll be honest, I can't say as I remember them all. Was it a good month? Sure. When we look at the numbers and how they finally transpired here for the year, for the month of October, fantastic. Let's go and let's do that. Let's break it down here. Now, sadly for me, worst performer was Bitcoin. You were down 4.28%. And I'm still questioning what on earth is going on with Bitcoin. It does feel like sheer manipulation. I had a good conversation with a friend of mine today about Bitcoin and how it's being manipulated by the bankers for, we'll just say, political reasons. And I don't know if I necessarily buy that this has been being manipulated that way. But the chart does not look good, right? We've been just sideways since July. We've been really hitting our head on this floor down here, which doesn't look good. Does not look good. Luckily today, we had a little 1.1% gain, but going into the weekend, I'd like to see some support build around this. But for the month, not good. Oops, there's a chart. What part of this chart hurt you, Merlin? I'm not worried about it, Jeff. I mean, I'm a long-term guy here, but obviously when you have something that was up at 120 4,000 and ripping through all-time highs, and then comes screaming back down to drop 18% over 11 trading sessions. Right? That's the problem, right? That was the pain point. And we had drawn lines on here which showed kind of a broadening formation. If you look at this chart here, I guess I can put those lines back on. From a loose trend perspective, we could draw in lines like this. I'll take snap mode off of here. And, you've got the highs are getting higher, but sadly, when you look through here, the lows are getting lower. So this is a broadening formation, which historically is not that great of a pattern. My expectation was that when we saw it come up here just on October 28th and 27th, and we got to that 115.16 level, I needed to close above 116 because that was this last turning point we saw on October 12th. Unfortunately, or October 13th, excuse me. Unfortunately, we didn't get that. And that has me a bit nervous because if there was, in fact, momentum and rally there, we would have broken above 116, gone back up towards the top, and challenged all-time highs again. But it didn't. So there's selling pressure out there. I have not looked at the leverage list to see how heavy the leverage shorts are right now, but my guess would be that the leverage shorts are piling into this bad boy more and more and more, trying to push it down. So, not looking good right now. What Don say, once banks and countries are involved, I do think they won't want the volatility of a crypto winter. So, as you guys may have heard, I think I've told you before, starting in January of 2026, January 1st, according to the Bank of International Settlements, there will be new rules put in place. There's two categories. There's Tier 1 and Tier 2. Tier 1 includes stablecoins, which means that all banks will now be able to custody stablecoins. Of course, they have to comply with the new rules for the United States, which is going to be no algorithmic stablecoins. It has to be asset-backed with 93-day maturities or less, cash, and repo market. That's it. Once these banks are compliant with that, you will see demand for stablecoins increase significantly. That's Tier 1. Tier 2A brings you into crypto, like Bitcoin, like Ethereum. Banks will now be able to custody Bitcoin, Ethereum, and other cryptos in two separate tiers. One is 2A, which is got specific rules. The second one is 2B, which has much stricter rules around it. So my guess is a bank will not be custodying something like Shiba Inu or Floki or Trump coin because there's really nothing behind it, right? That gives them some systemic risk. Whereas with like an Ethereum, you have a community of people building a project that has a whole ecosystem built on top of it. With Bitcoin, you have a payment system. So it'd be interesting to see how that helps foster adoption. Because to Don's point, banks aren't going to want that kind of volatility, which is why they'll move towards stablecoins. But stablecoins will be that piece that brings more people into crypto. And that is what I'm looking for, is the adoption phase. Probably later next year, you'll start to see more applications that will allow you to make purchases with crypto much more easily than today. Today, it's not that easy to make purchases with Bitcoin and stuff. So that was your worst performer, down 4.28%. On the heels of that one, you had crude oil, which was down 2.45%. That's almost the same percentage that it was down the previous month. So we saw some nice jumps up, but just not making great returns. Of course, we had that big sell-off starting on October 8th. It did rally back up and retest that one, and now, I don't know. We are in a downtrend here if you go from those highs back in June and even further back, right? You've got this kind of series of lower highs and lower lows on crude oil. But the question is, are we going to break that on one of these latest retracements back to the upside? I think any escalation in conflict could cause this thing to jump back up to 66, 68 in no time. But right now, a pullback off of that double top, or after that supply zone, which jumps up to $62, which we talked about that one on the Friday show, last Friday, the 24th. And that was your 2.45% to the downside. Next one on that list is going to be that 10-year yield. Still down 1.56 for the month. That should be good for real estate, but watching that S&P Case-Shiller Composite 20 home price and index number drop was not good. We went from 1.8 to 1.4%. Could the shutdown delay it to November? Certainly. Yeah. The shutdown can delay a lot of stuff, and I think the longer it goes on, the worse it gets. And I mentioned this the other day. We should all be mad as hell about this. We should be livid. We should be pissed about this. There should be fines or no payment for politicians, and they don't get back pay. It should be, I get the employees, maybe you get back pay, but for the politicians that stonewall each other for political gain or for their agenda and not the American people, They should not be getting paid. And we should all be mad as hell about this. And I don't care which side of the aisle you're on. It should piss you off. Anyway, 10-year yield down 1.56. Even though we had this pretty big spike over the past 6 or 7 sessions, same thing as what we saw with crude oil. Lower highs, lower lows. I drew this real loose trend line here too, which we can extend on out here. Obviously, that is not a tight trend line. It's drawn incorrectly. But the general gist of it is you are seeing lower highs and lower lows on that 10-year, which all in all should be good for our markets. The cheaper that money gets in the long term, the better. Right now, it does look like we're rallying back up. And my guess would be, which it is a guess, would be that we're going to come right back up to this last area of supply, which is the origin of this move down, which would be somewhere between 4.11% and 4.15. And actually, I think we tailed into it yesterday. Tested that one just a little bit. My guess is you'll probably see this. If it doesn't go sideways and lower, it'll probably go lower right away. But I do think overall you're going to see this continue to drift lower just because trend is your friend until the bend at the end. Next, we finally jump into positive territory with the Russell, which was doing phenomenal from a trend perspective. Still looks great. Still looks absolutely fantastic. But to end the month of October, it had a nice 5-day slide here and brought it down to only a 1.3% gain. But as far as trend goes, guys, it doesn't get much prettier than that. That's about as gorgeous as you're going to get. Higher highs, higher lows almost every single day. You know, on this most recent sell-off, I feel like this is just a buying opportunity. If you wanted, you could add on a moving average here and snug it up. All right, that's on a 50, but maybe drop it a little bit tighter here so it gets closer to price. There you go. Your 40-period moving average locked in. Russell was very choppy in October. Yeah, I certainly think it was choppy certainly for the month, but was it making higher lows the whole time? Yes. Why is the Russell doing anything? I was surprised to see that. I think it has to do with cheap capital, right? When you have money getting cheaper, the dollar is getting pushed down. You've got the 10-year yields dropping. You've got interest rates dropping. Typically what that means is more funding. People get access to cheaper money. Usually, historically, it's the small caps that take the charge there and really have more room for expansion. Now, as we get to the tail end of that, you get the big companies acquire the small cap companies, and then they surge up in price. But right now, I think that it's definitely the expectation that small caps are going to be beneficiaries of having cheap, easy money. Russell 2000 was up 1.33%. Your next victim, or your next celebratory person, I guess, 1.97. I closed out my S&P shorts today. Luckily, I made a couple $100 on it, but S&P was wild with regard to its volatility over the last couple of days. I bought puts on Wednesday, expiring Friday, so very short-term trade for me, which I normally don't do, but I ended up having an okay rate of return for just a couple of days. S&P 1.97% gain, and from a technical perspective, you look at that chart right there, better than the Russell, right? Not as choppy. Certainly had this one big down day on Friday, October 10th, which was that crypto crash piece, but all in all, great looking uptrend. You know, we had it mapped out here as kind of a spinning top going back to Tuesday's session, and had a nice sell-off out of it, and now try to retest that one. So for me, overall, you got to just keep thinking bullishness, right? Stay long because the trend is that way. I am concerned at how far away it pulls away from the moving average, but that's just me being a paranoid person. Typically, when you get overextended on a moving average like this, it will come snapping back to a moving average, but all in all, this still looks absolutely fantastic. Bought a little dip earlier. Nice. Good. And let's see. We're almost at the top. The Dixie. All right. This is one that we've been talking about. The rising dollar index price should be inverse to the markets. And we've seen positive markets and positive dollar quite a few times. The higher this goes, the more of an impact it's going to have on your equity markets, right? And we're kind of creeping towards that 100.25 line, which is this peak from back here in August of this year, August 1st. If we get above this, the 100 mark, I'd say 100 and a quarter, I'll let you know. I will probably start shorting the market. I hate to say it. The dollar can die. Certainly it can, Don. But as you know, the trend is your friend to the bend at the end. And while the long-term picture here looks ugly for that dollar index, look what's happening now. Okay, sure, we could say it's above its moving average. Sure, but really the trend that started back in September has been fairly nice. Higher highs, higher lows. This is what I'm focusing on because obviously I'm more of a swing trader. So for me, watching that market sentiment change since September is interesting. And I'm, you don't watch the show too often, Don, but I am definitely on my soapbox saying I think the dollar's going down. And it's going down, or it should go down because Bessent wants a weak dollar, so does Trump. Unfortunately, the market forces are beyond their control, and I can't refute what price is doing. Even though my belief is the dollar sucks, it's printed to oblivion, and it's going to go down, It's not right now. So my opinion doesn't matter. My opinion's irrelevant, right? I could pontificate on why I think the dollar is a piece of crap and going to keep on going down forever, but the price is moving up. So where am I making money off of is the price chart, not my opinion. All right, that was the Dixie. Let's see, two more. Gold. Ugh. Gold, 3.54 for this month of October. Let's bring up that GC chart. It's surprising it's only 3.54. If we were to go back to the 1st of October, which is right about there, and go to your peak, at one point this thing was up 13%. So it's definitely given back quite a bit. And this is also an example of what I talked about, right? I keep talking about how when you have something that goes outside of its normal trajectory, it goes parabolic, right? I wouldn't say the gold went parabolic, but from this August 20th low to its peak here on October 20th, this is a very unusual move for gold. It doesn't usually have such an accelerated move. And you look at how far away it's separated from the moving average here. Pick any moving average, doesn't matter. It got super extended, and the probability was it's going to come snapping back. I thought that we would stop right around the 4,000 mark. Well, we're right now at 3,996. It's bounced off this moving average a couple times. If anything, this becomes a buying opportunity for gold long term, but it just had to take a breather, had to take a little bit of a pause. And if we do see that dollar continue to increase, you would think that would impact gold negatively, but I think that that could actually impact the markets more, meaning push the equity markets down, and that would cause a flight from the equities into gold, again, even though the dollar's rising. I know it seems crazy. I am crazy. All right, last on the list, NASDAQ 100. And no surprise here for anybody, I don't believe. 4.35% for that NASDAQ for the month, and we know why. It's the Magnificent Seven. I mean, they are just looking so darn strong. Phenomenal run from most of Magnificent Seven, and everything's going to work until it doesn't. So what I'm looking for in the month of November is I'm looking for a turning point. I'm looking for a weakness to show up because it feels like markets are flooded with optimism right now. And as I've mentioned, my mentor back in 1998 always told me that a train moves from point A from its first stop to its last stop. At the first stop, no one's on board. And as it gets going, everybody gets on board of that train. And I feel like we're on that train and it's loaded. This trade is packed with that AI trade. And I feel like the AI trade reminds me, I reminisce about the dot-com bubble. Dot-com changed the world without question. It changed the world and the way that we do things, the way they communicate, find information, listen to music, do business, period. It changed everything for us. AI is going to do something very similar. And in that same parallel, you're going to have companies that are garbage, right? You may hear a report from Bloomberg or Fox or Jim Cramer or Charles Payne, could be anybody out there issuing a report on how great XYZ AI company is. But you're not there. You're not using the product, right? You're not in the company watching management. It could be a house of cards. It could be BS. And what I learned during the dot-com bubble is I would say probably 50% of the companies during that period of time were complete smokestacks. There were nothing to them at all. They were just vaporware selling this dream of .com. My concern is that some of this is going to come home to roost with AI. And what will happen will probably be something similar to what we saw with the .com bubble. Not saying we're going to get such a monumental drop in price. Let me go back here and look at the monthly on this, and I'll show you what I was talking about. If you go back here, this is your .com bubble. I mean, this is huge moves up and down on a regular basis, which I think AI is going to help facilitate. But the NASDAQ, let me go to snap mode here, from its highs in March of 2000 to its lows in 2002, dropped 83%. Now, I don't think that's going to happen. I absolutely do not think we're dropping 83%. But what I do think is going to happen is I do think that technology is going to take a bit of a breather here, and all of a sudden it's going to have a decent pullback, right? And where does that pullback lead us? If you look at this price chart here, I think all of you would agree that this looks a little bit extended. I mean, this is since 2017, right? Bill Gates says AI is bigger than the internet. Steve, I agree with him. I agree with him. I definitely agree that AI has much more disruptive power. But, what are we looking at? We're looking at, let's say, a 20% decline. If we got down here, would you guys think that this is out of the ordinary? For the people looking at watching the show, I just drew a little red line here. Would you say that this retracement here, this dashed line, I think it's red. Let me see what color it is. Yeah, is that green? Here, I'll make it red. I think it's red. There it is. Now it's red. Would you guys say that pullback there would be out of the ordinary? Would that be something like, oh, that can't happen. Oh, that's wild. Or totally acceptable? What do you guys think while I take a sip of this whiskey here to wash this down? Rob says, pull back in demand zone so we can add some to it. Big number there says, not out of the ordinary at all. Buy some more. Looks normal. Yeah, I would argue that would be a very normal pullback. And honestly, I think it's due. The question is, how long will it take, right? What I've got drawn here just shows, till July or till June of 2026. But is it sharper? Is it more, stretched out like this? I don't know. I really don't know. But I do believe that this market has gotten way ahead of itself, and I think that there's going to be a day of reckoning where AI and tech just falls out of favor. Right, Big Bright? I have no idea. I don't think it'll look like this. I don't think it'll be a 2-month just collapse, but stranger things can happen, which is why, when we look out at the market, let's go back to my daily time frame here. You do have a couple levels here where you could start planning ahead. One for me would be relatively close, and that would be like the origin of this gap, which is very close to where we are, right? 25,723. I think that's a bit early to really start freaking out, but I think if we broke this 24,442 or 422 mark on NASDAQ 100, that better be that point where you guys are like, I'm out, I'm done. I'm with you, Don. But Don, here's the key, and I think you would agree with me on this one. If we got to those levels, and I'm pretty sure, Don, you have a point where you go, I'm out, right? You've got to have it because you've been trading long enough, Don, to know that these markets don't go up forever, right? They're not invincible. And quite often, once that sell-off starts, it could really precipitate and get bigger. Especially, Don, knowing someone who says, I think you said at the end of this year, 50% of the workforce would be replaced by robots, if I remember correctly. But even if we got to next year and 50% of the workforce is replaced by robots, you shouldn't be long. Corporate profits might be up, but the unemployment rate will be so high that people will be out of jobs and no longer funding 401ks. So the money that's pouring into 401ks and investment plans would drop in half if we had that type of catastrophic, job displacement. So these are all things we got to pay attention to because while I'm looking at this market very, very bullish, my gut's telling me it's not going to last much longer. Not going to last much longer. I know Oliver's out there going, geez, Merlin, broken record. I will be right someday, Oliver. But bottom line is I'm long right now. I've got long positions only in this market. So, you can't call me the doom and gloom guy, but at some point we will see this whole thing come turning around. We'll be like, okay, now if it does, let's have that plan in place. And hopefully we'll be talking about it on the show when we have it in place. That's a bubble, though, a real bubble, super strong earnings, then right hook for markets. Yep. And earnings look great. Drew says, what would you consider what happened just in April of this year? I would certainly throw that into the bear market category, right? Especially if you look at just the sheer numbers. Let's go to the S&P 500. From a statistical perspective, we did have a bear market. I mean, we were down 21%, but we didn't actually close below 20% off the all-time highs, right? The key is you want to have a close below 20%. That's when all the markets will now, or all the news agencies will say, hey, we're in a bear market. This is bad. No, it's all going to crash and go to hell. That didn't happen. We never got that close. The deepest close we had was the market being down 18.8%. So, I would say that this was panic-driven. This was panic-driven by President Trump playing hardball with tariffs. And I think the market just overreacted to that one. Can't believe that just happened. I know, right? It was wild. And not only that happened a few months ago, but in light of all that, in spite of all that talk track and, his taco trades and everything, here we are at all-time highs and markets are ripping. I mean, watching the S&P go from its dead low back here in April to where we are today, market's up 42% in 145 trading sessions. That's phenomenal. Incredible. Big episode. Everyone's calling a bubble. It surely is not. Yep. Totally agree. And, I'm hearing more and more people not talking about the bubble. More and more people just talking about how you got to get on this train. You cannot be missing out on your Palantirs, your Nvidias, and your Googles and Amazons. Right? You got to own it. You got to buy that stuff. Well, that's driving it up. Ultimately, price will tell us, right? Price will be the piece that becomes the big decider. Runaway truck to the upside. Yeah, absolutely. YouTubers and people saying bubble have no idea what a bubble is. That's true, Don. Most of these YouTubers, it drives me nuts. somebody sent me a link to some 14-year-old kid that trades Forex who's got like 14 million subscribers. I'm like, this kid's like 18 years old. He has no idea what a bear market is, zero experience trading, but somehow this kid's got 14 million followers. Pretty wild. Crazy. And then people like myself who've traded for 28 years, I've got 7,000. Whoop, whoop. Bring it on. Let's go. I guess it all boils down to marketing, huh? All right, let me wrap this up because I got way too much stuff to get ready to for my haunted house and to scare these little brats that are going to come into my neighborhood. Moving on to Monday. So from your Monday's calendar perspective, you do have quite a bit of stuff happening for the U.S., all right? That's going to be November 3rd. We are done with October. Move on to November. You got the ISM manufacturing PMI numbers and prices. You got construction spending, but that construction spending is a government number, so that could be a little bit delayed. May not be out, released at all. You also have total vehicle sales. Those are kind of your big pieces for Monday. And then on the earnings front, I don't have the earnings calendar up yet. Let me bring that up for you. Palantir takes center stage on Monday, right? Obviously, PLTR, darling stock, right? One of the ones that everybody wants to own and love Palantir. I'm out of my Palantir as we speak, so I don't own any right now, but Palantir... Am I out of my mind? I thought PLTR was Monday. Oh, this is showing me this week. Thank goodness. I was like, wait a minute. I know it's Monday. Hold on as I update this bad boy to Monday, November 3rd. And there we go. And there's Palantir number one. Almost a $500 billion company. Gotta love it. PLTR reports on Monday. Vertex Pharmaceuticals, Williams Company, Simon Property Group. Just to name a few, but I think the biggest name for the week is going to be Palantir. All right. Merlin, you got to keep the costume, and every Friday. Crap coin. I am not pumping and dumping garbage coins, Don. It's not what I do. Not what I do. I'd rather people succeed than get lucky on one pick and make a bunch of money and run away. No, not my vibe, my brother. Not my vibe. Was there a trade deal with China? Lackluster for the markets. I didn't see any finalized. Trade deal. Did see what else do I have here. I think I'm good. What level of unemployment would you consider full employment if we're half the labor force were replaced by robots? Mike, I'm going to go to what Ben Bernanke always said. Ben Bernanke said 5.5% is full employment. So anything below 5.5%, in my opinion, we're doing great. The U.S. economy is doing fine. And here we are, in the low 4% right now. So I think we have plenty of upside move to unemployment before we really start freaking out. Now, if unemployment gets to double digits, then we got a problem, right? That's a lot of money not coming into the economy. That's a lot of money that people will not have to pay their mortgages. That's a lot of capital that doesn't get spent because there is no income for these people. But we're a long ways away from that. At some point down the road, we're talking years. I would say probably 3 to 4 years. I think we'll have a much more serious discussion about how bad unemployment is and how AI has replaced jobs and people aren't spending. And I think that could be a pretty significant economic crash going forward, but we'll have to wait and see. Even if the efficiencies made by these companies are so significant because AI allows them to replace lazy-ass workers and health benefits and all that stuff, I just hire robots, my in-store productivity or company productivity is off the charts. But if I don't have people to buy my product, then what? All right? Then I'm in trouble. So, I don't know. That's not today. That's not this year. That's not next year. I think we're talking 3, 4, 5 years out. We'll really start to see the impact of that. My guess is by 2027, we'll have a real serious discussion about potentially double-digit unemployment. But I can't worry about that now because the market's still got 2 months to go for this trading year and a whole 365 for next year. So that's it for me, everybody. I'm going to go get my haunted house ready for some kids. I hope you guys all had a fantastic day. I am going to wrap this one up. So cheers to all of you. Have a great Halloween. Even though you're not dressed up now, put on a costume. It's the one day a year you can be anything you want to be. Don't be an adult all the time. Go have some fun. So cheers, everyone. Have a great weekend. If you want me to discuss anything next week on this show, email me at tradermerlin@gmail.com. That said, happy Halloween. I'll see you guys on Monday.